This is InvestTalk. Independent thinking, shared success.
Gentlemen, this is Brett Shred from California. There's a stock you guys talked about in the past. I went in it pretty good, and I was just checking. It looks like it keeps gapping down. Just wondering what's your insight of what's happening there, if it's consolidating lower, or if you guys are still in it with your clients. Just want to see what you think of what you can tell me about ALSN Transmission, ALSN, if it's still good for a long term. It's in my IRA account. Thank you.
There we go. Looking at ALSN Transmissions. And yes, this is a name that we bought, I believe, in the 40s, mid 40s. It hit a 52-week high around 117, 120 in that range late last year, and then started to struggle near the highs. And we actually sold it definitely higher than where it is now. Now it's trading on $90 per share. But it's in a downtrend. And really what we saw was a shift in new truck demand. And so what ALSN does is they make the largest manufacturer of fully automatic transmissions for commercial vehicles. So if commercial vehicles are in high demand, their business as well, and obviously vice versa. So we saw that shift in demand and we decided to sell it. And so far it was good to get in. We're in the 40s, sold it, I believe, high 90s. We're at about $90.07 today. And it's trading, its earnings this year are supposed to be $8.75. But those analyst estimates are coming down. Last quarter, revenues were down 3%. Profits were still up 10%. But obviously, revenue growth has now stalled and expected to go into negative territory continuously for the next 4 quarters. Not major, 2 to 5%. But still, you can see that slowing demand for new commercial vehicle orders has translated into, as you would expect, slower sales for ALSN. Now, still a great business. So, from a long-term perspective, I still like it. We still like it. But we just found, at least in the medium term, better opportunities. And so we sold it, took our profits, and moved into something else. Certainly still a name on the watch list. Because like I said, there's a lot we still like about the business. Return on equity 48%, the minimal debt, good cash flow, etc. So if you have a long-term time horizon and you don't have ready need for the money or other ideas on the investment side, I think I'm fine with it because I don't think this is going to tank. I don't think it's going to go down to $50 or anything like that. But it could be going through more of a consolidation period, like you said, and over time could move higher once demand for commercial vehicles recovers. But right now, we just see better opportunities out there, and that's why we switched out of it. But long-term, still a very good company. Plenty of room to grow its dividend. Nice balance sheet, like I said, and highly profitable. Thanks for the call. Now let's go take a live call. James from New York looking at Qualcomm.
Yeah, you kind of just answered my question to a certain degree in terms of the earnings released today and it falling so sharply. But do you think it's a good time to maybe enter or add? Is it undervalued? I think it's below fair value at this point. But should I expect it to fall further and then enter at a lower price?
Well, Qualcomm is certainly not one of those names that is trading at a high valuation. Earnings this year is supposed to be nearly $12 per share. It's a $146 stock. Revenues still grew 10%. Earnings are up 19%. It was really about guidance, which was not as rosy as the market had expected, but we didn't think it was that terrible, to be honest with you. And if you look technically, it's still in an uptrend. I would say overall on the weekly chart, it's more neutral. It's been kind of consolidating here. But we still like Qualcomm. We think that they have incredible intellectual property, and it's one of the better value names in the chip space right now. So we think it's more of a buying opportunity than something to sell. So yeah, I think it remains attractive at these prices.
All right, thank you.
Thanks for the call. Now, every day we receive questions from the comment section over on the InvestTalk YouTube channel. So here's one that came in earlier. Kofi Ross says, what are your thoughts on IIPR? I think I answered this question last week, but IIPR is a cannabis REIT. They own a lot of cannabis facilities. They've had some issues with defaults as of late, but those properties aren't really going anywhere. It's just a matter of renegotiating the leases and making sure that the assets are fully utilized. And the lack of growth as of late, because they're dealing with more making sure their current properties are fully leased out, haven't been able to focus on that cash flow growth. But if you look at the actual numbers, their cash flow remains relatively robust, especially compared to its market cap, $241 million in free cash flow, and it's about a $1.4 billion market cap. So you have about a 15% free cash flow yield there, which is very strong. And that dividend yield, I think, can be sustained for the near term. It may be cut a little bit, but it's pretty high right now. But understand, it's high risk. This is a high risk play, and you have to treat it as such. Don't think that you're getting 14% with low risk. It's not. It is very high risk, but I do think it's a good risk versus reward.
Hello, my name is Michael, calling in from Maine, and I had a question about a private company called Pacaso. I guess they have a ticker reserved PSCO. Looks like it's the founders of Zillow, 41% year-over-year growth, offering shares at $2.90 a share. And I was wondering if I get your opinion on that as far as it being a private investment and the risks or rewards associated with that and your thoughts on the company. Look forward to hearing your answer. Long-time listener. Appreciate it. Bye-bye.
Well, I don't have much information on Pacaso because it's private. So I'm not sure exactly what they do, what the numbers are. If that price per share is expensive or not, it will depend on how many shares outstanding, what their revenue is, etc. You're gonna have to do your own research on that front. What I always say though with private companies is you really have to bet on leadership. That's what this is all about. Now, just because they work for Zillow doesn't automatically mean that they are great leaders. They could be resting on their laurels of what happened at Zillow. And frankly, if you look at Zillow throughout history, it hasn't been the best run company, despite its dominance in online real estate listings. Their cash flow is ebbed and flowed, and it's I wouldn't say it's terrible, but considering their dominance, it hasn't been a highly profitable business. So don't think that just because Zillow is a big name, that's once again automatically giving credence to the team that was from Zillow. Okay, so you have to do your own research. Like I said, if it's a private company, there's a lot of. I have one major private investment myself, and I did extensive due diligence on the leadership team, the products, the valuation. Luckily, I got in pretty early. Hopefully, that's the case here. Usually, the later you get into the later stages of fundraising, I think the bigger risk there is from a valuation standpoint. The earlier you're getting in, it's more about an execution. Okay, so that kind of depends on where they're at, right? In the later stages, maybe if they're talking about maybe going public, that they might have a symbol, that could mean they're in the later stages, and then it's about valuation. Okay, that their business is already moving, things are going well to a degree, and they're moving towards a public offering. That would be, okay, now what is the valuation? Is that reasonable? Is that something that could be achieved in the public markets and then some? If it's early, like I said, then it's more about who's the leadership? Do they really have a good product or service that is needed? What is the proof of concept? What's the market, the eventual profitability potential of the business, et cetera? So I wish I could give you more. I'm just giving you broad strokes, broad generalities without knowing much about the business. Let's go take a live call. Richard from Santa Clarita, looking at HKHHY.
Yes. Hi,
Okay.
Justin. That's Heineken.
Okay.
And I know there's also good idea now to, add some international exposure. to a portfolio,
Mm-hmm.
and wondered about Heineken. They're definitely, they're very prevalent throughout the world,
Mm-hmm.
and wondered if this may be a good company to invest in at this price.
Okay, looking at Heineken, this is a company that has not just the Heineken brand, but many other as well. Amstel is one that I'm noticing here. Dos Equis, Foster's, Newcastle Brown Ale. I'm just reading. They have a bunch of other ones, but Strongbow. I'm just looking at Tecate. They have many names within the beer industry, and about a $12 billion market cap. I think the issue here are broader trends in the alcohol space. Alcohol demand is declining, especially with Gen Z. It's just not only from a health perspective, but also it's expensive. You go out, locally, I just know, if you go out for a drink, $15-20 a lot of times. Even beers are $10-12, right? And it's just expensive, and the younger generation can't afford it. And so a lot of them are swearing off alcohol. And that's why a lot of the alcohol companies are struggling. I actually have one of my employees, his wife works in the industry. She's worked in the industry since college for nearly 20 years. And they're talking about, I think she works for Pernod Ricard, and they're talking about the decline in demand for alcohol. And so
Would that
what was that?
Would that trend that's domestically? Would you say that in that trend is a worldwide trend as well?
I think there are pockets of it. Obviously, it's not every country, but there are pockets of that worldwide, and so that's the issue. You're right. This does have global exposure. That's the positive here, but it doesn't mean that it's not without its challenges. Let me look at its geographical exposure. Yeah, 13.7% is the United States, 5.6% is Germany, 4.2% Brazil. So it is fairly diversified. That's a positive. But then if I look at the chart, it's also telling me that things are not going very well either. Let me take a look here. I'm just trying to pull up a chart on one of my screens. Yeah, I mean, if I look at a 3-year chart, this peaked back in 2023 at $48 per share. Now we're at $34. We've been in a downtrend really since actually 2021. We peaked at 51. So it's in a broader downtrend. Let me look at its balance sheet here. It does have a lot of debt, $20 billion in long-term debt, about $30 billion in net debt, on $2.8 billion in free cash flow. Times interest earned is only 7 times. That's pretty good, but not amazing. Return equity is only 4%. So its profitability has been relatively challenged and down from its peak around 10% back in 2021. So I just don't see, I see a lot of debt. I see middling profitability. I see middling cash flow, and I see industry trends that are just not in its favor. So if I'm looking for foreign exposure, I think you can do better than this. I don't think it's terrible, but there are too many headwinds and too many issues for me to get really excited about adding capital to Heineken.
Great. Okay. Well, thank you very much.
No problem. Thanks for the call. Now, speaking of entertainment and alcohol and traveling, shall we say, let's talk about Vegas. Vegas is a problem. It is struggling mightily. Part of it's the broader economy. Lower income consumers are struggling. But there's also fewer international travelers, especially Canadian travelers. Canadians used to make up about a quarter to a third of customers in Las Vegas. Now, Canadian travelers are very rare. And those working in the hospitality industry are starting to feel it, especially those that collect tips, for example. Now, historically, Vegas is very boom or bust. We know that. And it usually is the first to feel a rougher economy. And so far, visits to Vegas in the first 5 months of the year, down 6.5% compared to the same period last year. Now, that doesn't sound terrible until you look at hotel occupancy. That fell 14.6% in June. And the average revenue per available hotel room fell 19.2%. And there's an old saying, the economy sneezes, Vegas gets the flu. So once again, they feel it worse because there's not a lot of reasons to go to Vegas unless you have some extra coin in your pocket to gamble, to spend a little bit on nice restaurants, going out to clubs, etc. And that area is just hurting. And the costs, inflation has really impacted Vegas as well. Big transportation costs. The ability to get things to the middle of the desert in Nevada. It's not from a logistical perspective, not a very easy place to get things to. So the costs for food and the like are just a lot more expensive. They've been hit from an inflation standpoint worse than the rest of the country. And the region has been adding jobs at a lower clip this year than the country as a whole. And like I said, the costs of just going to Vegas have gone up considerably. For example, it's a cool restaurant. I recommend it. It's across from the Bellagio fountain. It's called Mon Ami Gabi. I just love going there, usually breakfast, and just sit out on the strip. It's always interesting. And they have good food. 4 years ago, a burger cost $16.95. Now, $30.95. So you can see just the dramatic impact that inflation has had on the city as a whole. And there are many casinos. There's the new Resorts World. They're struggling, burning cash. Fontainebleau, they're struggling, burning cash. So, there's just an overcapacity of hotel rooms. And now with foreign visitors drying up, they're just struggling. And I think this is the first major sign of the consumer tapping out. Now, once again, it's the foreign market, the foreign travelers, that's probably what's putting Vegas over the edge right now. But make sure that if you're looking at companies that have exposure to the Vegas market, I would be wary of them, at least in the near term. Now, there's no reason to stop now. Let's keep things moving and play another fresh listener question from 888-99-CHART.
Hi, Justin and Luke. Brent from Wisconsin here. I had a question about a dependent flexible spending account through my employer. Can I continue to pay my child's daycare out of pocket and reimburse myself at the end of the year? Of course, saving all the receipts and whatnot. And can I take that money and fund my Roth IRA with that reimbursement money from the dependent flexible spending account? Just wondering if I can kind of do a little 4D chess and fund my Roth IRA through those means. Thank you very much for all you do, and can't wait to hear the question on the podcast.
This is an interesting one. I don't hear much about the dependent care flexible spending account, and it's a pre-tax account that allows employees to set aside money to pay for eligible dependent care expenses. So talking about child care. And you can elect to contribute to this each year. And it's deductible from your paycheck, and taxes, reduces your taxable income. So it's kind of like putting money into an IRA. But once again, you can only spend it on child care for dependents under the age of 13. You can put $5,000 for single filers or couples filing jointly, $2,500 for married couples filing separately. Okay. There are contribution limits, though. based on your income, you can't earn more than $155,000 per year. Now, I think you were talking about taking that reimbursement. It's not really reimbursement. It's just money you can spend, it seems like, on that to fund a Roth IRA. I mean, I think those are just kind of completely separate, right? Because there are income limits on the Roth IRA. And ideally, you do both, right? Put money into this to spend on childcare, and then you'd max out a Roth IRA. So I wouldn't think of them as somehow connected. They're just separate types of accounts. So I would probably max out both if you can. Now let's go to another call and get to this voicemail message now.
I was looking to get some gold exposure. I wanted to see if you guys could touch on a company you guys talked about in a previous episode. It's called Agnico Eagle Mines Limited, ticker's AEM. I was just looking to see if this is something that I should be looking at or keep on my watch list. Looking forward to your answer on the show, and thanks as always.
All right, looking at Agnico Eagle, and this is one of the largest gold miners out there, $62 billion market cap. Earnings supposed to be nearly $7 per share this year, up 64% from the previous year, and then $7.40 next year. This is a name that we've owned for a long time, back when gold was in the doldrums, and this was trading in the $40 or $50 range, now at $124. It continues to be one of our largest holdings within the gold mining space. And it's just sitting there consolidating. So it's still in an uptrend, has a very clean balance sheet, well diversified, one of the best run gold miners out there. So that's why we own it. And yeah, if you are looking to gain exposure to the gold mining space in general, this is one of the best names you could choose. That was Agnico Eagle, AEM.
Hi, this is Matt in Florida. About a month ago, I made a call in regards to a 457B account and a target dated fund within it. And I really took that to heart and was looking at maybe changing the structure of that a little bit, where I have more control, where it's not shifting just to bonds as I get older. So I'm curious what your recommendations would be for a percentage allocation for someone who's 31 years old and trying to be highly aggressive. Specifically, I'm curious what your thoughts are on percentage distribution within a large cap, mid cap, small cap, and international equity. I've been really listening to what you guys have been talking about, where small caps have historically performed, but after 2000, it really seems like large caps are dominating. So I'm kind of looking for some guidance on a percentage for each of these distributions going forward. Thank you very much. Looking forward to listening on this podcast.
All right. This is a great question. This is actually something we do for clients all the time, and we dig into the so we manage for clients' 401k. So if anyone needs help with their 401k, 403b, 457, et cetera, we can help with that. But I'll give, and obviously we do that more intently, understand all the funds that are available in the account, which ones are the best for your particular risk tolerance. But I'll give you some broad overviews right now, being somebody, I think you said around 30, so pretty young. And, you want to be aggressive. So, a targeted fund will put you in some bonds, and maybe you don't want any bonds, and that's fine. So now you want to allocate to all equities, but how do you do that? What percentage in large cap, mid cap, small cap, and foreign? So for a long-term perspective, you're right, small caps tend to outperform, but mid caps tend to have the best risk versus reward, meaning they're probably going to have the best return over long periods of time compared to the volatility that you're going to see. Small caps are very volatile. You may get a little better returns than smaller large cap over long periods of time, but you may not, as you've seen recently. But mid caps are kind of that middle ground. They're big enough to where they obviously have very strong, large businesses, consistent businesses, but there's still a lot of room to grow. And so that's why you tend to get better risk versus return. So I would lean towards a mid cap if you're younger. So probably something like a 30, 40, 30, 40, 30 of spread out in that way from a large, mid, small perspective. But then you also want to sprinkle in foreign, especially right now. You're starting to see The dollar's getting a little stronger, but I do think the dollar's generally in a downturn because of our fiscal situation and just money starting to diversify out of the United States. And so I do think money will flow into those foreign markets. And so you want same kind of breakdown, large, mid, and small, but in foreign markets as well. Okay, so I think 30% should probably be in something like that. Now, once again, it depends on your plan, depends on what funds are available. You know, if you have a large cap fund that's really crushing it and you really like the philosophy, et cetera, and it's aligned with the market trends, then maybe you overweight a little bit more large cap. So it does depend on your options within your 401k. But that's generally how I would think about allocating the equity side of a 401k, 457, 403b, et cetera. Now, lastly, let's touch a bit on general advice. And this is a great segue because it's very important to understand that everyone has their own bias towards investments, liquidity, volatility, et cetera. And there's a lot of, we even use them. It's called Nitrogen. It's on our website. It gives you a risk score. And it's great. It's a great starting point for understanding a client's or potential client's risk tolerance level. But it's also very important to understand who that person is, what their preference is for. And a good example of this is there was a study and it looked at liquidity of investments. And you would think that everyone would want more liquid investments. But the reality actually is a lot of people want less liquid investments. Why? Because it allows them to limit their ability to access those funds. They're aware of their own lack of self-control to go and raid those assets. And so they want something that is more locked up, or there's a fee to take money out until a certain time. And so understand that while the general consensus is you want liquid assets, that's not always the case for everybody. So that's why I think having a financial advisor when you get over $100,000 in assets plus, that's when you start thinking about engaging with an advisor that can really figure out what your preferences are, what your needs are, what your goals are, and recommend the right strategy for you. So I wanted to talk about that briefly, not because I'm trying to get clients or anything like that, but more just understand that rules of thumb don't apply to every single person. The average means that there's a lot of outliers. So never take the average and think that's automatically going to apply to you. It depends on your personality, your goals, and where you're coming from. Well, I'm Justin Klein. This completes another InvestTalk program. And if today's show did make you think about your own financial picture in any way, I do encourage you to head over to investtalk.com and schedule a call with myself or Luke for a free portfolio review. And we thank you for listening to this podcast and radio show. We encourage you to tell your friends and family about our free podcast downloads as well. And be sure to get your anytime at iTunes, Spotify, or YouTube. Be sure to rate and review on iTunes as well. Independent thinking shows success. This is InvestTalk. Good night.